$1,000. Let's say right now in 2020, I was starting over hypothetically with $1,000. How would I invest it? I've been investing for over 20 years. I've built a successful dividend stock portfolio. But if I were starting all over again, I get this question all the time. How would I do it? And how would I do it right now in this crazy time of this global pandemic and of economic uncertainty, but at the same time, a disconnected stock market where stocks are generally valued at pretty high levels? How would I do it? I'll tell you how I would do it. I would take my $1,000 and I would invest it, hypothetically speaking, all of it in Johnson & Johnson stock, ticker JNJ, my number one favorite dividend stock of all time. And so in the video today, I want to cover Johnson & Johnson. I want to share why I selected this particular stock, why I would put all of my eggs in one basket with J&J. So I'm going to do some fundamental dividend stock analysis. I also want to share in the video today my expected returns by putting my hypothetical $1,000 in Johnson & Johnson. What could I expect? What could I expect over the long term from this investment strategy? I want to talk about some of the risks. I want to talk about some of the benefits. I want to talk actually how I would purchase this stock, how I would go about actually purchasing these shares, and so much more, everyone. Get ready for a really exciting dividend investing video. All right, everyone. So I want to start out today with the fundamentals, with the facts, because so many people like stocks and they choose different stocks. But for me, it's not enough to like something. It has to be fundamentally sound. And so I want to share on the screen with you right now some fundamental stock analysis with Johnson & Johnson. So get ready, check out your screen right now for some cool statistics. And basically what you'll see is right now, Johnson & Johnson, it is trading at $137.81. And quite frankly, I am surprised that it's trading at this level, given how strong the stock market has been. Despite the economic uncertainty, most stocks are trading at higher levels, and I would have expected J&J to be trading higher. And so off the bat at 137.81, I feel like it's a reasonably good price for J&J. It's a reasonably good entry point. We'll talk more about this in a minute when I get to the price earnings ratios. And so J&J pays a dividend of $1.01 per quarter, or annualized, that is $4.04 per year. And so the starting dividend yield is just under 3%. This alone is very compelling for me. I do invest for dividends. I primarily invest for dividends because I use dividends to pay bills. And with J&J, what's so nice about it is the current yield is just under 3%, which is pretty strong given the overall market we're in, given how low interest rates are. But also, this is a company that grows the dividend over time. So you kind of get the best of both worlds with this thing, in that the starting dividend, it's pretty high, but it's also going to increase over time because J&J has a long-standing track record of increasing that dividend every single year. And I expect that to continue into the future. And so really strong dividend stock. Now, the earnings per share estimates from the analysts, the analyst consensus estimate for 2020 is $7.72, and for 2021 it's $9.05. And so per share, the analysts expect the company to earn this amount in 2020 and 2021. Now, if I do a PE ratio, which takes the price, divides by the earnings per share, I get a PE forward looking on 2020 of 17.85, and for 2021 forward looking, it's a 15.23. And this is why I was saying a minute ago that I feel the current share price, I'm kind of shocked by it. I'm surprised about it. Not only is J&J my number one favorite stock of all time, so even at higher levels than here, if I were hypothetically starting over, I would feel fine putting all of my eggs in the basket, even at higher levels. But given that it's trading at these levels, given that on a price earnings ratio basis, It is trading quite attractively as compared to other strong world-class blue chip companies. I feel like it's just a good entry point, so that is very compelling. Now, Johnson & Johnson carries a market capitalization of $363 billion. What this means is the entire value of the company, if you multiply the price per share multiplied by all of the shares outstanding, this is the value of the enterprise. And this company basically is like a mutual fund of sorts in the healthcare space, because J&J tends to grow through acquisition. And so they've purchased all of these companies over the years. It is a mutual fund, a holding company, if you will, of all kinds of medical device technologies, pharmaceuticals, and consumer-facing health products. And so I love J&J's three-pronged approach, and I love their approach also of having grown successfully through acquisition, because so many companies fail when they make acquisitions. Johnson & Johnson has a secret sauce where they are successful with acquisitions, and by buying into this, again, it's a diversified company, it's a diversified portfolio, pretty much of the entire health care space, which is really, really exciting. And so I want to share with you on the screen right now another table. And what this table shows you is the dividend growth history. And so if we back up all the way to 2015, the quarterly dividend for Johnson & Johnson was 75 cents. But if I fast forward to the quarterly dividend right now, it is $1.01 per quarter. If I use the fancy formula that you see on the screen right now, it tells me on average how much J&J has raised its dividend per year over time. And over the last 5 years, the compound average annual growth rate of the dividend, it comes out to be 6.1%. Now, if you've been watching my videos here on YouTube, I'll link to the last one in the description below, where I shared 3 companies that I'm purchasing right now in June and July of 2020. I shared with you that one of my really kind of gold standard criteria of dividend investing is a 7% or more compound average annual growth rate of the dividend. Now, J&J comes in a little bit below that, and so I do have to be fair here that not everything about this company is perfect. One of the things that I see is that the rate of growth of the dividend, it is starting to slow. It's a little bit slower. It's a little bit under my 7% mark, but coming in at 6.1%, I feel pretty comfortable with that. I feel pretty good about that. And certainly with any investment, there's pros and cons. One of the cons here is a little slower growth, but one of the pros that comes with that is rock solid stability. And that's something else. If I were hypothetically investing my first $1,000 in 2020, I would want to pick something really stable. And that's part of the theme today as well, as stability. And so I want to move on now to the next screenshot. What I'm summarizing on the next screenshot are some really exciting metrics, fundamental analysis from J&J's earnings report. And this is the annual earnings report for the year of 2019. And so if you look here, I am comparing a 10-year period. It's really exciting that in the annual report, they have a summary at the beginning, and the summary gives a nice 10-year comparison. And I'll share that on the screen right now as well, just so you can get a flavor of what that looks like. As an investor, whether I'm investing my first hypothetical $1,000 or whether I'm, 20 years into it, investing a lot more money, it always makes sense for me to dig into the numbers, to take the time to look at these types of metrics. And so I'm actually going to now switch screenshots. I want to show you on the screen right now my summary of the metrics that you just saw. And what I'm doing is I'm putting a CAGR, a compound annual growth rate, onto some of my favorite metrics. And what you see is the revenue over the last 10 years. The revenue has increased on average by 6.4% per year. And so this is a company that is growing its top line sales at about 6.4% per year. And I find that impressive, being a company of the scale, of the magnitude that J&J is at. It's already a big company, and it continues to grow its revenue really quickly. If I look at the net earnings are growing on average by 4.3% per year on average. And so the net earnings go from $12 billion, $12.2 billion, all the way up to $15.1 billion. So really strong results there. On average, they're growing those earnings by 4.3% per year. So a little bit less than the revenue growth, but the earnings are still growing. And that's what I love about this company. It may not be growing so quickly. It may not be hockey stick growth, if you will, but it is slow, predictable, steady growth. And that's what I would look if I were deploying my first $1,000, is having a core stable company. And quite frankly, Johnson & Johnson, for those who have been here a while, if you want to check out my entire dividend stock portfolio, I will link in the description below how you can get your hands on that for free. J&J is my number one position by weight. I have the most money out of all of my stocks in Johnson & Johnson. One of the reasons are these predictable numbers. It's not necessarily a get-rich-quick type of holding, but it is slow, steady, predictable growth. And you'll see in a minute that it gets me to where I need to go. It takes time. It's get rich slowly, which is what my channel is about, but it's get rich slowly, predictably, and without taking on undue risk. And so earnings are growing just fine. Now, moving on to the next metric, what you'll see is net margin. Net margin does dip. It dips from, and net margin is, I'm just taking the earnings divided by revenue, 39.7% in 2009 down to 35.9% in 2019. So it's a negative 2% growth per year. Now, if I had to say something negative about Johnson & Johnson, in addition to the dividend growth being a little bit slower than I like, is their margins are shrinking. Now, that being said, the margins are shrinking, but the margins are very, very strong. And so we're talking about something shrinking, but something shrinking that is already really, really promising. And so there's kind of two ways to look at it, that, hey, net margins are really good, but they are a little less good than they were 10 years ago. Moving on, what we see next is the earnings per share. That is up 5.1%. And you may wonder, why is the earnings per share on average up more than the net earnings? Well, it just so happens that the share count has been reduced over time. So fewer shares being bought back makes it easier for a company to show earnings per share growth. Now, what I find really important these days is so many companies have practiced financial engineering, meaning they've just buy back shares. And when they buy back shares, it boosts their earnings per share. And it looks like, hey, earnings are growing, but they're not really growing just because the share count is decreasing. And they're using debt oftentimes. I'm not talking about J&J. I'm talking about other companies, just random general commentary here on the stock market. But this is why I look at not only earnings per share, but the net earnings, because net earnings cannot be engineered by share buybacks. Earnings per share can. And so that's why at J&J, I'm so excited to see the net earnings growth. So moving on, what we see next are assets. I thought it was interesting to see that their assets are growing pretty aggressively. Long-term debt is as well. But honestly, long-term debt is pretty low. It's only $26 billion for a company that is valued at over $360 billion. So not too bad. And dividends, by the way, over the 10-year period, and you see it's $375 here. This is again from 2019, so that's why it's not at the current rate, which is $4.04 per year. But in the year of 2019, what they paid out was $375. You see that the dividends have grown. Dividend per share has grown over the 10-year period by 14.2%. So dividend growth is slowing down in the last 5. And I think the last 5 is more indicative of what we will see as investors going forward. But historically, dividend growth has been even higher. And it just goes to show, hey, maybe it is possible that they beat that 6.1% going forward. But to be conservative, I look at it at 6.1%. So there is a lot more I could dig into here, but I want to keep this video reasonably short as far as my videos go. My videos are all pretty long, but reasonably short because I have a lot more ground to cover. But the picture I'm trying to paint is, long story short, most companies don't look like this. Most companies do not look this good. These metrics are really, really solid. And I can go into many more, but I think this is good for now. And what I'm trying to say is if I were deploying 1,000, personally, hypothetically speaking, and I put it all into one stock, which is what I would do. It's just how I do things. And I put it all in one stock, it better be a premium company with really good metrics like I just shared. So I'm happy to report on such good metrics. And so what I want to do next is I want to transition into the second segment, and I want to share, okay, so I'm putting 1,000 in this thing. What could I reasonably expect? What could I reasonably expect in terms of the performance of my investment, both from a capital appreciation standpoint and an income, a dividend income standpoint? And so check it out on the screen right now. And by the way, what you see on the screen right now will be available in the description below and in the pinned comment below. I will have a mechanism for all of you to download this spreadsheet at home and play along at home. Don't worry, you don't have to enter your email or anything like that. Literally just click it and I'll have it in the description below for everyone to view. So what you see on the screen right now is actually a spreadsheet that I created just about a year ago. I did a video a year ago where I debuted this spreadsheet, but I updated it for today's video to go over the J&J case study. And so in year one, which is basically right now, with $1,000, I could afford to buy 7.256 shares. That would come in at a value of $999.95. And so I'm assuming zero commissions. Here in the U.S., we don't pay commissions anymore, just how it is. So no commissions factored in, no commissions need to be factored in for United States investors. Now, global investors, this is a global community. I know a lot of other countries still have commissions, and so that would need to be factored in. But more or less at a $1,000 tranche level, commissions aren't going to hurt too much. And the share price is $137.81. And again, dividend per year, first year 4.04. First year dividend income is just going to be $29.31. How do I get that? It's literally $4.04 multiplied by 7.256, the number of shares that I own. And the yield on cost, it's the dividend income divided by my cost, which is $1,000. And so two assumptions go into this model. The first assumption is the dividend growth rate. I am assuming that the dividend growth rate grows at the 5-year compound annual growth rate level, which is 6.1%. I also make the assumption that in terms of capital appreciation, the share value grows about 7% per year. And so when you download the model, if you want to enter different numbers, those yellow cells are all cells that can be changed. And so at the top, you may have different assumptions than me. Personally, I believe I'm choosing realistic and also somewhat conservative assumptions. And I think that's important because our economy is in rocky times. That being said, look, what is the last thing people are gonna stop paying for? It's health-related stuff. Everyone wants to take the best possible care of their health, and that's why I look at companies like this as defensive companies, because whether the economy is good or bad, healthcare is so critical to all of us. Our health, it's the most important thing, and especially during a time with a pandemic, company like J&J. They may come up with the cure, and if they do, certainly that's something that could help the company even further. But anyways, what you see on the screen right now is a summary of performance over time. And so I'm assuming, again, 7% capital appreciation per year. I'm assuming 6.1% dividend growth. And what I'm doing here with this particular investment is I'm reinvesting all of my dividends. This is so critical. If I were hypothetically starting over with 1,000, the most important thing I would do is hold for the long term, not touch it, not mess with it, and reinvest dividends. So those two things are so critical. And so what you see in year two is I have more shares. Why do I have more shares? I took all the dividend income from year one, to buy more shares. And so each year the share count goes up. The reason the share count goes up is I am buying shares, and I'm buying shares at increasingly higher prices because the share price is going up as well. And so this really is the miracle of compound interest. And you see compounding here happen a few ways. You see it because the share price is going up. It's compounding over time. You see it because the dividend is going up. It's compounding over time. But you see it, the third thing that is so powerful for dividend investors is you see it because the dividends are getting reinvested to buy more shares. And so money that's getting paid out is passively going back. And that money that went back, it's now earning even more money that gets paid out. This is the miracle of dividend investing. It is that compound interest. It is that reinvesting. It is that yield on cost, if you will. And so I just want to move out here. What would happen in 10 years' time? Well, in 10 years' time, I could expect that my $1,000 is worth $2,364. And I could also imagine that in 10 years' time, based on my modeling, I would be yielding $64 in passive income in cash flow per year. And if I take my $64, I divide by my original amount invested, which is $1,000, my yield on cost after 10 years' time would be 6.42%. Let's move out to the 20-year marker. After 20 years of investing, my $1,000 has now become $6,000. And so my returns are just fabulous, and I am yielding, in terms of dividend income, $150 per year for a yield on cost of 15%. Let's move out even further. Let's move out to the 30-year mark. And so at 30 years' time, I have 15.3 shares. My value of my investment, which is my share count multiplied by the share price, is now at $15,000. My 1,000 turns into 15,000, and my dividend income is $344 per year, or a yield on cost of 34%. And so what you see here that is so important is, honestly, in the first 10 years, not that much happens. The real gains start happening as time goes on. And so again, this is not get rich quick. This is get rich slowly, but it is get rich slowly in a predictable, in a stable, in a sustainable, multi-generational way. And so for people who can work hard, for people who have commitment, for people who don't just invest 1,000, but after the first 1,000, keep investing more and more and more. They keep going for it. They keep saving money and investing more. This is the type of strategy that can build truly amazing generational long-term wealth for the people that have the hustle, for the thug life investors, if you will, the thug life investors, the OGs who have what it takes to keep going the distance. And that's what it's all about. And that's what's so important to point out here, that if you're someone potentially who wants to invest 1,000 and then double the money overnight, this is not my strategy. That's not what I'm sharing. But hypothetically, if I were investing $1,000 right now, I wouldn't be looking to do that. I would be looking towards the long term. And that's the strategy that I am employing right here. And so with that being said, what I want to do now, let's go into some of the ways that I would buy this thing. So this is so important. There are two ways that I would probably go about if I wanted to hypothetically start over and buy J&J stock. The first way I would possibly look at is a major stock brokerage like Charles Schwab, for example. And so I want to share on the screen right now some statistics. I pulled this from the Charles Schwab website, and what you see right here basically is $0 online equity commissions. So there's no commissions. You see that there's no minimum account balance. And so $1,000, you're not going to be charged some ongoing fee for not having enough money in the account. And there's 0 monthly service fees. And so What I would say, quite frankly, is so many people these days, they're buying stocks. They're getting caught up in these things. I see it all the time, like on YouTube and on Twitter and elsewhere. They're like, hey, sign up for this broker you've never heard of before. And by doing so, get 2 free shares of stock or 1 free share of stock. And usually when you sign up and I see people getting free shares, they get like a share of stock and just junk. And what I'm trying to say is, I don't want these free shares. You know why? It's accounting. It's more accounting. Why would I want free shares of some junk stock that now I have to account for? And if I ever sell the thing, I have to report on it. The time that I would spend accounting for it is not worth getting these free shares. Quite frankly, even if they gave me a free share of something good, something expensive, it wouldn't be worth my time. And I'm just speaking to my personal experience, but with free commissions, with zero ongoing fees related to low account balance, that kind of stuff being in the past, I just don't understand why people don't go with the major brokerages other than getting fooled. And so I'm just saying, I don't know, I'm just speaking to my personal journey, speaking my mind. I got my own thoughts as to why people go other routes, and I think a lot of it comes down to affiliate commissions. But anyways, keeping it real here, Charles Schwab to me or other comparable large brokers these days seem like a mighty good option. Now, the other option, if I didn't feel like going with a large broker, is potentially just buying the stock direct through a dividend reinvestment plan. Check it out. I'll share on the screen right now. The transfer agent for Johnson & Johnson is a company called Computershare. When you buy through Computershare, there's pros and cons. I did a whole video on this a long time ago. I'll link in the description below. But basically what you're doing is you're bypassing the broker. You're bypassing the middleman. You're buying stock directly from the company. And what's so cool about buying direct is, you know, when you buy through a broker, even a big guy, the shares are in the broker's name. They're in the street name. If you buy through Computershare or the transfer agent, you buy directly, the shares are in your name. They're actually in your name. And so there's some pros and cons going through it. Now, some dividend reinvestment plans, also called direct stock purchase plans, sometimes these days have higher fees. But the reason I'm sharing J&J's on the screen is it's one of the ones that still exists that has lower fees. And these plans can be very good for small investors and also large investors. And you can see here, if you make a recurring purchase in here, you have a $1 fee for your recurring purchases, and they also do charge fees for sales. But if you're just doing regular purchases, nothing recurring, you're just kind of putting in money here and there, the company is paying for that based on this schedule that I see here from Computershare, at least based on how I'm reading this. And so again, you could buy stock directly theoretically and not pay commissions, and also avoid the middleman. You're going direct, which is so cool about that. And so those are the two ways that I would approach it. I would either go with a transfer agent, go direct, or I would go with a big broker if I were hypothetically starting over again. But how I would not approach it, I would not be bamboozled into signing up to some affiliate link, making someone else's dreams come true to try to get some free shares of like Zynga stock or something. I'm just saying, just being honest, that's not what I would do. But no offense to everyone out there. I hope this isn't like a create too much controversy out there. But anyways, moving on, what I want to do in the next segment of the video is I want to share with you some of the risks with this. So let's look at some risks. It's always important to look at the risks, sharing it with you on the screen right now. And so the risks with something like this is, look, it's a single stock strategy. It's a single stock strategy, and putting all of my eggs hypothetically in one basket, if I were starting over at the 1,000, that's riskier than, say, putting it in an index fund. For me, I just cannot bring myself to go the fund route. Index fund, ETF, none of that. No disrespect. A lot of dividend investors here do that. They love it. More power to them. But I'm just saying, for me, I can't do it. And what it ultimately comes down to is I am someone who is a fan of bypassing the middleman. I just don't look. I know a lot of these funds these days, they're not even charging fees. There's always a fee. There's data fee. They're using data. They're using your data. Look at the fine print. They're making money somehow, or they're using it as a loss leader to market other stuff. And so for me, and look, I did a whole video, I'll link in the description below. Historically, my strategy of picking stocks, individual stocks, has beaten the index. It has surpassed the index. Will it do that going forward? I don't know. I believe it will at least track the index, but I'm happy to do that as long as I have a dividend-centric strategy, which spins off more cash flow, which I can use to pay the bills, because that's my strategy. And also, quite frankly, just so I can buy the stocks directly and I'm not going through a middleman, just because that's how I am. I'm a man who has a lot of belief in my capabilities, and I just don't need someone else to do it. I don't need a middleman. It's just discouraging for me to go through a middleman. That's just how I look at it. But again, if you do, no disrespect. And so, but that is a risk. It's a single stock strategy. What else is a risk? With this particular company, we unfortunately live in a society now where being in any industry exposes a company to risk of litigation, these large companies. Now, unfortunately, with J&J, there's kind of two things right now looming in the background. One of them is the opioid crisis. Certain people believe that, hey, J&J, you're at blame for creating the opioid crisis. I don't want to comment on one way or another here. And certainly I want to show sensitivity. Anyone here who has faced challenges with addiction, with opioids, certainly I don't want to make light of that. That is horrible. And I pray for anyone in those challenging situations. My heart goes out to you, or if you know anyone like that. I'm just saying, from a company standpoint, there's certain people out there that believe that J&J or other companies like them may be at blame, and I don't want to quite frankly, I don't want to judge one way or another. Let's leave the court of law to decide that, but that's a potential risk. And the other risk is the talc powder. There's been some reports and litigation out there assuming that alleging that the talc powder in the baby powder product is causing adverse health effects. And so the lawsuit is alleging that there may even be asbestos in some of the samples. And so again, my heart goes out if someone is affected by talc powder. Look, I don't want to comment one way or another. I don't know the answer. We'll leave that to the court of law. I want to basically just share, though, that there are risks with a company like this, even above just single stock strategy. It's just the stock itself, despite all of the good numbers, despite all of the diversification, despite its scale, there are things that could come in and rock the boat. Although historically the company has done well navigating the storm. And so the third risk that I see with all of this is, quite frankly, we're in a really bad economy right now, but the stock market, because of the pandemic and everything and the economy shutting down, but the stock market keeps surging. Now, thankfully, J&J is priced based on PE, at least on a reasonable basis, but stocks are hot, economy is bad. Generally speaking, that's not something I like to see. So I see that just as kind of a macro stock market thing. Look, if I were starting my journey now, the first thing to do would just be to start the journey. And so if I had 1,000 hypothetically to start over, I would just put it all in right now. But I would also acknowledge to myself, hey, Ian, you may be buying at the peak. Things may be headed down. And I would be okay with that because, again, this would be a line in the sand. My first 1,000, it would be a line in the sand. And from that, I would be looking to build and to deploy and to add more over time, because ultimately the goal would be a much larger stock portfolio that was yielding a lot more passive income that could be used to either pay partial bills or all of my bills one day, and would allow multi-generational wealth to accumulate. And so those are some of the risks. I want to move, though, now into some of the benefits as well. So check it out on the screen. And what are some of the benefits? It's pure quality. I would just choose this stock because, in my opinion, out of all the stocks I own, it is pure quality, is probably the best quality, and hence why I have put all of my not all, but it's my number one position by size. So I've put a lot of eggs in that basket. I like the scale. It's like a medical industry mutual fund. Health, as I mentioned already, health matters to everyone. Even in a bad economy, people need the products that J&J sells because it's for their health. I think it could outperform the index. I believe my modeling here is a little bit conservative. I generally have seen in the past that premier quality companies like this one tend to outperform the index over long periods of time. And so I think there's that opportunity. Again, Ian, why wouldn't you do the index? It's not only about kind of, hey, I don't want to go that route just because I don't like the middleman, but it's also, I believe I can beat it. And again, my back testing that I have done for my 46 stocks that I can own, that you can see all of them if you check out the link in the description below. Historically speaking, it has beaten the S&P 500 index with dividends reinvested on both. And so it could beat the index. And again, I can't stand paying a middle man. And so that's what I would do. Right now, 2020, hypothetically starting the first leg of my journey with dividend investing, I would take $1,000 and I would just put it in J&J right now at current levels, and I would keep focusing on the hustle, and I would look at the long term and figure out how to build from there. All right, everyone. So before I leave today, just some quick housekeeping. I want to share an update with you. Some of my OGs who have been around here since the early days might remember a number of years ago, I had started a Patreon and then I removed it. I decided to do it again. And so I just want to share with all of you, I have been putting an enormous amount of work here into these YouTube videos. I love it. And I'm getting a lot of positive response. And I want to continue to invest as much time as possible. And the reality of running a YouTube channel like this is that there are costs associated with it. During this whole global pandemic, unfortunately, the CPMs and advertising dollars, if you will, have been going down a little bit. And so I thought, hey, I'm going to give it another go. One of the reasons that Patreon for me didn't work the last time I tried it a few years back is that I was trying to offer kind of premium level stuff there on Patreon for the patrons. And by the way, for those of you that don't know what Patreon is, it's just a little platform outside of YouTube that people can use to financially support this channel. And so what I decided this time is I'm just going to have 2 tiers of access on Patreon. I'm going to have my homies and I'm going to have my Thug Life investors. And at the homie level, you can contribute $3 a month, Thug Life investor level, $10 a month. And what I was thinking is that, look, maybe from time to time I'll share some exclusive stuff on Patreon, but I'm not going to go that route like I was thinking last time. This time, again, I share all of my best content here on YouTube for free. I don't have a course. I don't do anything behind Content Gateway or anything like that. And I'm going to continue to do that. But what I wanted to do is reach out to the community, all of you, all 60,000+ of you that I love so much. I appreciate your support. And I just want to ask if you feel that the free content here I am sharing on YouTube has benefited you, has helped you, has encouraged you. It is something that you want to see me continue to do, and not only continue to do, but continue to make it better, continue to do it more frequently. I just ask that please could you take a look at my Patreon, and if you feel that you would like to contribute, it would mean the world to me. And again, I'm not going to do it like last time where, hey, you do Patreon, you get special stuff. No, whether you're a patron or not, I want everyone. This is dividend investing for everyone. I want everyone to have my best work for free here on YouTube. Again, that's something that differentiates my channel. I'm not doing the hard push on XYZ affiliate that you get free stocks by signing up this and that. No, I don't do that, quite frankly, because I shared earlier in the video today how I would hypothetically buy Johnson & Johnson, and that's what I believe, and it doesn't align with those affiliate things. And so I don't have a content gateway. I don't do courses. I share my best content here on YouTube. And I just ask, hey, if you like what I'm doing here, consider becoming my homie or my Thug Life investor on Patreon. I'll include a link in the description below how you can check that out. And if you do decide to contribute, it means the world to me. It helps my dream. It helps this community. It helps this YouTube channel continue to grow because I have huge expectations, huge aspirations for this YouTube channel, well beyond what's even happening right now. Also, I just ask if you like the video today, please give a thumbs up, a like, comment, subscription. All of that means the world to me, and all of that greatly helps growth of this channel and my mission here on YouTube to share the best possible dividend investing content for free with everyone. I love you all. In terms of a friendly disclosure, full disclosure, I own the stock mentioned today. I am long Johnson & Johnson, ticker symbol JNJ. Also, in terms of a disclaimer, this is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. Just sharing my journey here on YouTube for fun and entertainment. Investing in the stock market carries great risk, especially in 2020 when things are so crazy. It's very possible to lose money in the stock market, and a lot of money at that. So please keep that in mind and share your strategy with your financial advisor before making any decisions. Thank you, everyone. I love you all. I will see you in the next dividend investing video.